Bristol Meyers Squibb, stock ticker BMY, is currently trading under $50. They are year-to-date down 31%, and if we zoom out to 1 year, they are down 37%. Bristol Myers is facing significant risk from patent expirations of its blockbuster drugs, which make up a substantial portion of its revenue. The strategic response, such as new product launches and pipeline development, may not be enough to compensate for that anticipated revenue shortfall. So in this video, I want to take a close look at Bristol Myers to maybe see whether or not it is in value territory and whether or not the intrinsic value could indicate a potentially good time to pick it up. And while the price graph is looking a bit like a ski hill, we want to take a closer look at the valuation. You can see it currently trading at a PE non-GAAP 4 ratio of 6.6 compared to a 5-year average of just below 10, a 31% difference to the 5-year average. While a low PE ratio is often attractive, indicating potentially undervaluation, it may also hint at expected earnings headwinds or a market anticipation a very slow growth for BMI, for example. And if you jump into the EPS estimates for BMI, you can see for 2023 and 2024, the year-on-year growth is actually negative. So that could indicate that the market think that there are some earnings headwinds indeed for BMI and that the pipeline development may not be enough. But jumping into the dividend summary, you can see it offers a yield of 4.58%, annual payout of $2.28, a payout ratio below 30%, which looks extremely juicy to be honest, 5-year growth average of just over 7%, and a dividend growth streak of 7 years. And if you jump into the dividend history, you can see while the dividend growth streak is only 7 years, you can actually see that the dividend payout streak goes back 30-something years, back to the 1990s. So if you're merely looking to pick it up maybe for the dividend, it could potentially be a pretty good time at the current levels. But let's jump into the financial statements to gauge whether or not the company is in a healthy financial state to grow the dividend in the future. First thing to take a look at is the revenue. Is that growing? And indeed it is. Back in 2018, 22 billion up to around 44 in the last 12 months, almost double up basically. Coming down here to the net income, we also want that to grow as well. 5 billion back 5 years ago, up to 8 point something now. So indeed also growing the net income. And if you jump into the cash flow statement as well, you can see that net income starts at the top here, and then we scroll down to the cash from operations. So basically, cash from operations minus capital expenditures is the free cash flow that can be used to pay out dividend. So 7 billion back in 2018, up to roughly 30 billion now, and the capital expenditures have not grown quite as much. So you can see roughly 1 billion 5 years ago, up to 1.2 now. So plenty of free cash flow to pay out as dividends or invest into further drug development, new pipeline acquisitions, and so on. Scrolling down here, you find the free cash flow per share as well. So if you come down to the bottom, you can see the free cash flow per share sits at 5.49. And if you remember the annual payout ratio being 2.3 roughly, then there's plenty of free cash flow still to grow the dividend in the future. Before we jump into our own calculations, let's see what the analyst thinks about BMI. So they have it rated as a buy at Wall Street basically with 20 analysts over the last 90 days. It's a bit of a divided stock to be honest. A lot of people on the strong buy side, some on the buy side, most people on hold, and a little bit on the strong sell side as well. So coming down to the price targets here, you can see currently trading around the $50 mark. There is at least according to the analyst, an average price target of roughly 28% upside at 64. But we do want to make our own calculations as well. So jumping into our stock screener, zooming in a little bit, you can see everything a little bit better. Key metrics up here, we have gone through a bit of them. We are very close to the 52-week low. The PE non-GAAP 4 ratio is dangerously low, basically could indicate a potentially undervaluation. So let's jump a bit further into some of the numbers here. You can see net debt to EBITDA sits at 1.6 roughly, way below that 3x ratio I would like it to be at. Return on invested capital, return on equity also looking really good. Return on invested capital roughly in line with the 5-year average, and return on equity actually above the 5-year average. One thing I also do note here is the price to sales ratio at just 2.2, really low basically. So could again indicate a really strong opportunity at the current time. The current yield and so on we have gone through that. The payout ratio here is a bit above the 60% mark. So basically this is based on which numbers you'd use to calculate on it. This is definitely wrong. I did double check that. So we use this to calculate our margin of safety. So if this gives a +5, which it should do, then I will obviously exclude that one. It has both a pretty strong 3- and 5-year dividend growth rate. So taking a closer look at the dividend data, you can see here, we zoom in a little bit to see everything a little bit better. And what we're looking for here is basically steady growth. So we want these numbers here to be as steady as possible, basically. The dividend growth rate over the last 5 years, over the last 10 years, sorry, is 5. And if you take a closer look at some of the numbers, you can see back in the early days for Bristol Meyers Squibb, the dividend growth was really low, below 3%. You can see in these numbers. Ever since, they're actually grown quite a lot more, around 9, 8, 10%. Down a little bit the last time, obviously, but still, it's looking pretty good. So I would definitely think they could keep up these maybe 7% going forward. Jumping down to the dividend yield graphs, you can see here, at least according to the dividend yield theory, it could indicate a roughly 30% discount at the current levels. As you can see here on the graph on the right, whenever we move into the blue area above the line, it could indicate a potential undervaluation. And whenever we move below, it could indicate a potential overvaluation. So we are indeed way above the line at the current time, as you can see here on the graph. But to support that, we have a lot of other valuation methods, such as the discounted cash flow model. Zooming out a little bit so everything is a bit more clear. We also have the dividend discount model, the multiples valuation, Graham's revised valuation, PE model, the free cash flow valuation, and the Peter Lynch model. If you do want to double check any of the numbers or estimations I've put in, then please rewind to the video and pause a little bit. I don't want to go through every little detail, obviously. But before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary, where we do have all our valuation methods here. I have chosen not to exclude any of them because, as you can see, all of them are positive, and I think all of them are pretty okay to use in this regard. This gives us an average intrinsic value of $73 per share. With the current price being $49, the average current discount sits around 32%. And if you remember from the dividend discount, from the dividend data, you can see roughly also 30% discount. So jumping back here, you can see we also obviously want to apply a margin of safety. To do that, we have our margin of safety calculator over on the right. We start with a standard of 25, and based on some of the key metrics, we either add or deduct a little bit margin of safety. In this case, a margin of safety becomes 15 based on this. I do, however, want to change that a little bit because, as you remember, the payout ratio was actually below 60%. So in this case, this should just be 10. So let's put 10 over here in our margin of safety cell, which recalculate the acceptable buy price to $66. So in my conclusion, this paints a picture of a company at a crossroad because there are some obvious significant patent expirations coming in the future, which clouds it a little bit. And I have some reservations about the company's ability to offset this expected downturn with the current pipeline, and the management's optimistic projections strike me as a bit too rosy, basically. So while the numbers here look pretty okay, it doesn't really take into account this patent expiration for some of their top drugs. So personally for me, I would wait a little bit longer and see if we maybe could dip below 40s, which would put it at a 5-year low basically. And at that time, it could probably be a pretty good buy and a pretty safe buy, because obviously the history of innovation and the portfolio from BMI cannot be discounted. And I think the near-term headwinds is a bit too strong to overlook. So I would definitely wait out a little bit and maybe keep a close eye on the company's execution of the strategic initiative they are planning in the coming month, and then return to take a closer look at the stock again. Thank you so much for watching, and I'll be seeing you in the next video.